The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
Now you see on display the connections between travel, connections between supply chains for Apple, for all of your tech industry, for many of your hard manufacturers here in the United States and around the world. You see the world as one complex system. Change the flow of interactions in a connected world, and there are significant effects, not all of them positive.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, sometimes looking at the news, it's really hard. We've got an awful lot of sources. Back in the old days, we had 3 networks. And even if we were getting a narrative that might have been massaged, most of us shared in that narrative. Now, what we've got internet. And we've got all different sources of information. And so this morning, in relation to the coronavirus, I was talking to a man that I know. I meet with him on Tuesday mornings with a number of other men. And I asked him, I said, you've got a manufacturing company in China, and you're over there about every 6 weeks. His wife is Chinese and just got back. She self-quarantined herself for 2 weeks and looks like she's fine. But my question was, how serious do we take the coronavirus?
Yeah, we're left in an interesting place because here we are in a small town in the mountains of Colorado.
Right.
And it seems
a little bit of
like
a bubble.
Yeah, it seems like it would be a bubble. In our neighborhood, doctor comes back from vacation. He's been in Thailand for 2 or 3 weeks. They stop off in China for 3 or 4 days. His daughter gets off the plane with flu-like symptoms. Local doctor's back to work. Daughter's quarantined for a couple of weeks in the same house. But, again, like how close do these things get? Well, it was just the flu. It wasn't the coronavirus. But you realize how interconnected the world is. And as we look at asset markets, we see that there's judgments made about the state of affairs, right? So we are left to judge the judges.
Well, and actually, you can look at how things are being judged in the markets, hopefully by the price. That's what free market is the pricing is who's judging what, going what way.
Yeah, and what I mean by judging the judges, this goes back to Keynes, how he described the markets, which is like a beauty contest. Not that we are choosing who is the most beautiful contestant, but you're betting on how the judges will vote, how the judges will vote.
Right.
So we're left to judge the judges, and we wager on the opinions of others. That's the nature of the markets. And today's challenge is the divide between the fixed income investor and the stock market speculator. So yeah, both are a part of the collective judgment on where markets go next. And with reference to the coronavirus, you've got global economic implications of the virus, and there is a divergence of opinion. In the Treasury category, you have yields which have been coming down. Okay, so buyers are pushing yields down, prices of bonds are going up. Gold, too, is holding up very well.
Right.
As a safe haven, that's in contrast to your industrial metals, which show a real concern as well. Copper's still above its 2016 lows, but it has traded in recent weeks in its longest losing streak since 1971.
Well, it sounds like it's signaling recession, at least for the industrial metals.
Well, so to recap, you've got safe haven bonds. They're attracting buyers, even as industrial commodities and the energy markets find sellers. And so what you have is the indications from these markets that we have a long and difficult road ahead. And there's consistency in these assets, all signaling the same thing. Concern is palpable, and it's tied to a series of unknown variables. So if you're judging the judges, the fixed income side of the equation, at least the conservative end of the fixed income market, there's, again, concern is palpable, and it's tied to what we don't know, which is concerning. And that is reasonable, frankly, in the investment markets.
Well, and I wonder if you can hide anything with liquidity for a while, because the markets are awash in liquidity. I looked at what the People's Bank of China was printing. I looked at what our QE, our non-QE4 is putting in, the $60 billion a month, plus the repo markets, plus the Fed buying 80% of the treasuries. The markets are awash in liquidity. So is that hiding something? I mean, look what the stock market's doing, Dave. It doesn't care about the coronavirus.
Yeah, liquidity is a big key. And, you look at loan covenants, they're getting lighter and lighter, with some bonds now not even having claim to the assets or the income of the underlying entities, which is just crazy. But that's the state of affairs we have. $250 trillion in global debt. So again, there's been a lot of liquidity infused via the credit markets into global economies. And equity investors, that's the other side of the equation. So we're talking about judging the judges and there being a divergence of opinion. The other opinion is the equity investors, to this point, quite sanguine, maybe naive, overly hopeful, given the quantity of unknown variables.
Unless you're in Shanghai.
Right. So if you're in the Shenzhen stock market or the Shanghai stock market, those exchanges have been pretty nasty. But here in the U.S., other than a few days of consolidation, you can see kind of a collective shrug in the equities markets, whether that's due to belief that liquidity from the People's Bank of China will be sufficient, or that the whole issue is just sort of a small blip on the screen. And we don't know.
Well, and sometimes looking through the front of the windshield is quite different than what is in the rearview mirror. Now, the rearview mirror, if we were to look at earnings, Apple, McDonald's, Dow, MasterCard, looking backwards, they were reporting gains. How are we looking for Q1 in 2020?
Yeah, and maybe it's better than expected earnings from some of the companies you mentioned. But I would still argue that we're in an environment where you have more liquidity being pushed into the system. The equivalent liquidity being pushed into the system as you had after the attacks of 9/11 and from Lehman Brothers. So that massive amount of liquidity in a period of time that predates the announcement of the coronavirus. So these are supportive of speculative trends. And then, of course, yes, you've got Apple, you've got GE, McDonald's, Dow Chemical, MasterCard. Maybe the better than expected earnings supports economic growth thematics. And I guess the word of caution I'd have there, the word of caution I would have on that point is that S&P 500 profits have been advertised as rising at about a 6% annual pace.
Now, are those profits coming from actual profitability or are there games being played?
Well, that's the point of caution, because I think the majority of the benefits and profits have come from an engineered set of results. So talking to CFOs, the majority of those benefits, you're talking about one-time write-offs, you're talking about share buybacks, you're talking about huge compensation packages, which are not expensed, complements of non-GAAP reporting. And GAAP is the general accepting accounting principles. And what most investors don't know is that when you're looking at your earnings reports and things of that nature, most of them do not fit GAAP reporting. They're non-GAAP in nature. And just kind of a small subnote, you can kind of make it up as you go along on a non-GAAP basis. But again, those are just a small sampling of the tricks that are used, the accounting misdirection that's used. And it was Fred Hickey that pointed out that from the U.S. government Bureau of Economic Analysis, real business profits have flatlined since 2014. If you're looking at the non-engineered financial results, U.S. corporate success is kind of hit and miss. It's not great, right? And so what is it about GE? Well, I think GE, of anyone in that mix, you could probably pick on in terms of financial engineering. Apple, they had good sales. We'll get to that in a minute.
Okay, but so let me ask. I was thinking about this morning when I was making my coffee. I thought, what can we equate what we're doing with the liquidity to? And all of us have credit cards where we can get cash advances, and you can pull that cash out, and actually you can fatten that wallet up quite a bit. But what you're doing is you're creating debt. And I mean, look at what the world central bankers have done over the last 6, 7, 8 years. They've gotten so cocky about what liquidity can do that the European Central Bank is now saying that maybe we can solve climate change with liquidity. How about coronavirus?
That was the point of having the central banker for the Bank of England on late last year, was to have an idea of what is the scope of central banking.
Right.
When you're talking about unelected power, are there limits? And he was very clear that if you don't have a defined and specific mandate, you're probably going to be operating outside of a lane where you can actually be effective. So one thing is certain, if Christine Lagarde can solve climate change with monetary policy, then the coronavirus should be no different. Let's just give it to her as an assignment.
Just print money.
And that's what he was getting at. He was saying, come on, really? No, there's a few things that we can solve, and the majority of the world's problems we cannot. But to the equity investor, and that's where I think we come back around to this difference of opinion and judging the judges, perhaps it's the equity investor who's concluded that money printing is a cure-all up to and including the coronavirus.
Okay, but your Apple, let's say that your Apple and a lot of your production is actually coming out of a place that right now is quarantined. Does quarter one look like it's going to be affected relative to Q4 2019?
Yeah, I think when you think about Apple, even with a stellar earnings report most recently, they are acutely vulnerable in Q1. The first quarter of the year, you've got Chinese markets playing a significant role, and both in their success last quarter and in this next reporting cycle. And it plays a role both in terms of the retail sales, but also the product manufacturing, which you talked about in terms of where the production's happening. Foxconn is the Taiwan-based builder of most of your iPhones, and they build them on the mainland. So you get product manufacturing, which is now behind schedule with the extension of the holiday, and uncertainty as to whether or not factories will be able to resume full production levels. Not to mention that some of their part suppliers are in the Wuhan region.
Well, and let's just bring up also, we've talked to guests who are experts in Chinese economy, and they said that the change, Stephen Roach said this, he said the change that needs to come in China is they need to become consumers of their own goods. Now, the Lunar New Year is a big time of spending. China has become a big consumer of its own goods. And from what I understand, there's no spending going on for that holiday, or virtually none.
It's a big season. We see a seasonal uptick in gold because there's gift buying and things of that nature. There's a huge seasonal factor there, just like the Christmas season for us, where you see consumers doing more than they usually do. And if you look at the percentage of retail sales here in the U.S., it's all clustered. You say it's 70-80% is clustered around the Christmas season. Mm-hmm. So the Lunar New Year spending, the consumption side, there in China, and we're talking total consumption, restaurant spending, travel, not just buying Apple products, that was down 40% from the previous year.
40%. That's huge.
Yeah. So again, it's a period of consumer spending like our Christmas season. Retailers depend on it. Chinese GDP is roughly 50% derived from the service sector. And this is where the big hit is. Consumption, services, under pressure.
Dave, when I was in college, as you know, I was a toy store manager, and toys did 75% of their business from Thanksgiving to Christmas, a very similar type of thing. Now, if we were down even 5%, that was a massive hit to the industry. Can you imagine? 40% down.
Yeah, well, Apple's also relevant to keep in view in the context of equity index buying here in the United States. Apple was the largest contributor to the S&P 500's gains in 2019. In terms of market cap, it added $700 billion to its own market cap last year, topping out at $1.4 trillion. It's sitting right at about that level today.
That's amazing. Trillion. Do you remember when it topped $1 trillion?
Yep.
Same year,
yeah.
Right?
So iPhone sales in China soared at the end of last year after significant price cuts. Big help for Apple as they finished the year on a strong note. That was a far larger contributor than expected, and it helped make up a decline in revenue from services, which, by the way, Tim Cook was very shy about addressing on the conference call. What part of the services was in decline, he would not say. So that was kind of an unexpected hit on the service side, but more than made up for cell phone sales in China, lowered prices, and people clamoring to own the product. So there's no way for that kind of increase to be repeated. There's no encore performance in Chinese iPhone sales in the first quarter, where you've got a lot of consumers living temporarily as shut-ins, not willing to even go out and get groceries, with food products being delivered to them, right? They're not going out. Consumption is held in check.
Well, and for the listener who's saying, well, yeah, but I don't have Apple, so I'm really not that vulnerable. If you look at the indexes, Dave, most of these 401ks, they're indexed, and it's really 4 or 5 stocks, like the FANG stocks, that includes Apple. So it really does affect the overall bottom line.
Well, we're going back to the issue of capitalization weighting, where the largest companies, primary stock indexes, if you're talking about NASDAQ, Wilshire 5000, S&P 500, the biggest companies like Apple, Alphabet, which is the new name for Google, Amazon, Facebook, they get the biggest flow of fresh money into the index because they're cap-weighted or capitalization-weighted indexes. Apple's been riding high on that, catching capital flows both from your index allocators who are putting money into NASDAQ, and the NASDAQ 100, and S&P 500 index funds. So fast forward to Q1 2020. It's not out of the realm of possibility to have this non-virtuous cycle of disappointing results, my expectations for Apple in Q1, followed by a decline in Apple's share price, right? Selling in the index, because it's a huge component within the index. And then you have the selling begets more selling daisy chain, just like you've had the buying begets more buying momentum trends to the upside, except in this case, it's in reverse.
It's interesting that you would again mention momentum, because momentum has really proven itself over the last 6, 7, 8 years, but especially the last 2 years. What most people have forgotten is that momentum works both directions.
Yeah. I mean, the bottom line is that Apple's China, or if you want to consider it sort of coronavirus exposure, it puts U.S. indexes at risk in the early part of 2020. And I think this is something to consider or linger on. Does deflating a $1.4 trillion company have a domino effect into the U.S. markets broadly when that company, Apple, is the single largest company on the planet, owned by more investors, more hedge funds, and included in more cap-weighted indexes than any other company on the planet? We'll see. But if I were CEO of Apple, Tim Cook, coming into first quarter reporting, just to keep the audience mesmerized and engaged, it's about time to announce a $100 billion share buyback and just sort of, ooh and ah the folks. A return of shareholder value. Oh, you don't want to sell now. And I'm serious. It may take a carrot that size to keep the market from taking a bite out of Apple.
Well, and when you do that, you're actually buying Apple at all-time highs. So what you're saying is you're going to take $100 billion worth of Apple money, buy at all-time highs just to keep it from going south.
That's right. So there are other sectors that were already suffering in mainland China prior to the virus outbreak. You had auto sales, which had been in decline every month over the last 18 months, nearly 2 years. January reports showed auto sales at an 8.2% decline year over year. So no surprise. And I think that'll continue as we see this month unfold. Families are huddled at home, waiting for the virus threat to either peak or dissipate. Maybe it will. We hope it does.
Okay. So I'm going to sound conspiratorial. Sorry, I have to do this. But a year ago in January, China just flooded the market with liquidity because things were starting to turn south. GDP's been falling for a while. You've talked about auto sales falling. In September, we started seeing massive infusions of liquidity worldwide, including in the United States. And we called clients. There's a lot of people who are listening who got a call from me. And I said, hey, I don't know what's up, but they are acting like there's a crisis right now. Before the crisis, we're seeing infusions of liquidity, quantitative easing 4. We're seeing all of these things are occurring before a crisis. Then we have coronavirus come up in December. Now, I'm not necessarily saying they're tied together, but isn't it interesting that we now have an excuse for what was already occurring?
Yeah, well, I think, I won't go there in terms of the conspiracy side of it, just because I think you look at financial conditions and they are unstable. It doesn't really matter what the trigger is for consequences into the financial markets.
You can see where people would make the tie, though, if they were looking ahead.
But the instability is already baked in. Right. We talked about $250 trillion in global debt. That's kind of a big deal when you're talking about, 320% of world GDP. That's massive.
Do you think they'll call this massive. The corona recession, though? In other words, whether it's the trigger
the blame,
or not.
Sure. No, it could take the blame. But the PBOC, People's Bank of China, since the outbreak was really acknowledged, they didn't want to for a while, but $200 billion, they've done that a couple times now in terms of infusions, reverse repos, and other means of getting money into the market, liquidity provisions to keep things steady.
Now they're having to also deal with rising prices. You've got inflation kicking in China. That can cause hunger on the low side.
Well, again, it's not just a question of Apple and that being sort of a domino effect into the U.S. markets. We have GDP figures, and you're talking about inflation. That certainly is factors into real GDP growth. Nevertheless, Q1 numbers, they're going to be ugly. GDP growth was already coming in at 29-year lows. Auto sales reflected consumers struggling between economic reality and their ability to get maybe somehow on the liquidity gravy train from the BBOC. A lot of liquidity was flowing towards real estate. Real estate in China here is very vulnerable.
That's been skyrocketing. Okay, but what about consumer prices? I mean, just the price people pay when they buy food.
And that's the big jump. We talked about that in our portfolio manager meeting this week, where Chinese consumers are having to deal with a jump in inflation. The all-in CPI figure is higher by 5.4% year over year. The food components jumped by over 20%. And just, you got to have some historical reference here. There's nothing like food inaccessibility, either because of supply or price, to agitate the Chinese population.
Well, and speaking of agitation, okay, we have the tariffs that are in place. And I sometimes wonder if, because of this crisis, we're not going to see something change, because the pressure right now, pressure's really on the Politburo.
The phase one trade deal basically said we're not going to do an additional $250 billion, and maybe someday we'll be friends. But there's still about $350 billion of tariffs that are in place between the U.S. and China. And if you think about that, that is a pressure point on the Politburo. The consequences of coronavirus, what that does is it puts the party in yet sort of a more vulnerable position. And we go back to George Friedman's comments last week.
They were scary, because he was talking about weakness actually could turn into some sort of strong arm action.
Well, and he was referencing Russia, where, again, you bring in a dictator, and that's not an indication of strength. Xi Jinping did this a few years back. Placement of a dictator in a position of power for life, is that a sign of weakness or strength?
Right.
His conclusion is that it's weakness, and you're kind of organizing politics in such a way that you can manage through some sort of decline, whether it's an economic crisis or what have you. But the decline in Chinese economic growth and the potential for unrest, they've been increasing for several years, right? And now you've got the virus catalyzing discontent in a new way, because here, certainly food inflation has always placed Chinese leadership in the danger zone. Last year, we had massive pig culling. Now you've got transportation issues, transportation constraints, not being able to get animal feed to your poultry farmers. That's, again, it's complicated by various quarantines and restrictions on movement, but it's kind of a big deal when you're trying to feed 1.5 billion people. Food costs are rising. And, at some point in here, you might even find that price controls just become an ordinary course of events.
I think we've talked about you can handle almost any emergency if you have a little bit of savings, if you have some reserves, but the reserves have to last over time. We've talked before about people running out of money before they run out of month. You can actually run out of money before you run out of year or decade if this turns into a long crisis. Duration, or the time, seems to be the real critical key here, doesn't it?
Yeah, sure. And, there for individuals, you might think in terms of neurochemistry and kind of the reserves that you have on an emotional basis, or how you invest in a relationship and sort of create a reserve. But when you're talking about nations, that's really no different. You're still talking about, with different language, it's no longer bandwidth, but it is savings, it's reserves. So temporary impact is what we have in China right now. Duration is the key idea. I think I'm focusing on here. Duration of a crisis is really critical. WHO just declared, the World Health Organization declared the virus a public health emergency. You've got 27 countries that have confirmed infections. So there's sensitivity now. Sensitivity to contagion.
And the planes are not flying in, yeah.
They suspended all flights.
Right.
That was because American pilots, airline pilots rather, their union was suing the company because they're kind of dragging their feet on pulling the flights. Pilots didn't want to go. So at last count, you've got 22 airlines that have canceled flights into and out of China. 15 different airlines have cut some or most of their flights. And again, this comes back to the issue of duration. One of the more interesting consequences of the virus in Wuhan is the challenge that it represents. I'll come back to duration in a minute. There's a challenge that the Chinese political apparatus has with reputation.
They're used to managing information, Dave.
Well, and so maybe it's less of an issue if you plan on sort of strong arm tactics and managing a crisis, in ways that you probably couldn't as effectively in a democracy. But you had 8 doctors. They identified the virus in the first weeks of December. They were censored. They were detained for spreading false rumors. Now you've got one of those doctors, 34-year-old, died this week.
Right.
From then to now, which is false rumors, not an issue, shut up, to now one of the largest quarantine operations in human history. You've got basically 50 million people restricted from travel, and the reality that the virus is continuing to spread exponentially. 1,000 people have died, officially about 40,000 with the virus, and maybe unofficially it's, I don't know, could it be twice or three times? Who knows?
This morning I had talked to this man whose family is in China, and his wife's parents both are retired doctors, and immediately they canceled all travel plans. This was early on, weeks ago. So when someone says, all right, well, how serious is this? You've got people who are doctors who are saying, no, we're not going to travel. So within China itself, people have to inform themselves other than what the actual official story is.
Well, again, crisis dynamics are very manageable as long as you're not dealing with an extended crisis. But if you're dealing with, again, duration is the key. When crises are short in duration, you've got reserves of social, reserves of political capital, and they're typically sufficient.
But you burn that savings up if it keeps going.
Yep. You extend the crisis and you wear through all of your reserves. If you had all the money in the world, including all the liquidity from all the world's central banks, but you've spent through your social and political capital, you're doomed.
Yeah, but let's say we're a stock market investor right now. Hey, Dave, we're really near all-time highs. Why wouldn't we continue to pour in?
And again, that's where we come back to judging the judges and there being a difference of opinion between your risk-off and risk-on appetites. You've got a few investors who are saying, yeah, I'd prefer treasuries. I'd prefer gold. And then you've got others who, the equity markets, to be judging this one right. If they're right, if they end up being right, the duration of this crisis has to be short. It has to be short. The question is, how do equity investors know what doctors and scientists cannot be certain of? That's beyond me. That's beyond me, which is why I favor the judgment of the treasury buyer and the safe haven investor over the equity index allocated.
Well, and let's take the coronavirus out of the equation. We were talking about things that were already occurring. You had mentioned that Stephen Roach was talking about the declining GDP numbers for the world. I mean, the entire globe was already declining before we ever heard of corona.
Yeah. Just one more comment on this equity index allocator. They may end up being right. The duration of this crisis may end up being very short, but they have no evidence to support that.
Right.
So, I mean, there's questions of faith and fact, and this is the equity investor having faith in something. I don't know what, but this comes back to, could it be that this belief in liquidity is a cure-all? Liquidity is a cure-all, including the coronavirus.
So do you go long the inoculation announcement? Because let's face it, if somebody came out and said, hey, we just figured it out, here's the inoculation, at that point, do you play long on that?
Right. Well, so I mean, a few weeks ago, you mentioned Stephen Roach. We had this in the commentary. Global GDP. It is declining for 2019. The IMF figures showed 2.9% growth figure. You're like, well, growth. Hey, it's growing. Well, in the light of 40 years of data, we are 40 basis points away from signaling a global recession. So when you get into a band between 3.5% and 2.5% with Stephen Roach's argument, you're in a band of concern, and 2.5% GDP growth, you've already tipped the scale towards global recession.
And we're 2.9 now.
2.9.
Yeah.
The IMF numbers were not heartening in that regard. Now, factor in China-specific contributions to global GDP. They have been the largest contributor to total global growth, and factor in the regional freeze in travel and consumer behavior. In Asia as a whole, the region presents a significant drag. China specifically, but Asia as a whole represents a significant drag on global statistics. So U.S. growth, you may say, okay, well, it's positive. Okay, it is positive. But as positive as it is still anemic.
Yeah, we're spending money we don't have. I mean, what's $1 trillion here and there?
That's my point is even if you've got a positive number nearing 2% in the U.S. economy, let's not forget that $1 trillion in spending, really, in my view, is not healthy at all. It goes straight to the national deficit. All right, we're just tacking it on to the $23 trillion that we already owe. Deficit spending, $1 trillion this year, $1.3 trillion next year, and every year for the next 10 years.
That's what they're planning if nothing goes wrong.
That's right. GDP growth here in the U.S. is okay at best when you consider that about 7% of our GDP figure, between 5 and 7, is really future consumption dragged forward into the present by deficit spending, right? That's the reality. Certainly not growing to a degree here in the U.S. that would offset weakness elsewhere.
Okay.
Not seeing that kind of growth. Here's where there's a big difference between U.S. domestic economic reality. Again, anemic but positive. Not arguing with 50-year records for unemployment. That's fine.
Even if it's paid for with debt.
All right. So, but financial market realities are a little bit different. So let's argue that the U.S. economy stands out as a beacon of strength relative to or compared to the European and Asian economies. On a relative basis, we really do look pretty good. But our financial markets, this is where I think we're missing something in terms of the pricing of U.S. equities, because our financial markets are geared to reflect global trade in goods and services. Our largest companies, the biggest components in our equity indexes, derive a considerable part of their sales revenue from overseas, from abroad. So you've got U.S. listed companies showing very well, but they have a geographically diversified revenue stream. Sometimes that helps you. But here in the first half of 2020, I think it can only hurt you. Yet the indexes don't reflect that vulnerability.
Well, again, it goes back to liquidity. Everything is awash in liquidity. If you're taking your credit card down and getting cash advances, you're going to feel rich for a while, but you're going further and further into debt. So how much does money printing actually cure?
We said it before, looking at the collective judgment in the marketplace and seeing this very different move in safe havens, treasuries, and gold versus the U.S. equity market. Perhaps the equity investor has concluded that money printing is a cure-all. Sure. You don't have to be concerned with any other facts. And that seems to be the factor sort of in the risk on buying liquidity. Central banks continue to accommodate.
Well, okay, but look how interconnected we saw we were back during the global financial crisis. Okay, we actually saw the connection right then. It was almost like a virus as it spread, but it was in the money world. Now what we're actually talking about is a true metaphor, a true virus.
Right. The coronavirus is a fascinating reminder, not only of the interconnected world we live in. You're right. The global financial crisis demonstrated a unified and complex financial linkage, right? So now you see on display the connections between travel, connections between supply chains for Apple, for all of your tech industry, for many of your hard manufacturers here in the United States and around the world. You see the world as one complex system. Change the flow of interactions in a connected world, and there are significant effects, not all of them positive.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, and you can call us at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.